Carrie, do you have that change on the time?
I do.
8 to 10 minutes. Charles is doing project number 4 from the professional seminar from the Advanced Communication Series, The Professional Speaker. The speech will be 8 to 10 minutes. Please welcome Charles Shaw.
I'm going to set up here real quick, a little presentation. I have to reach over. Turn on, hopefully. Maybe we have to turn on the black one. Can everybody see that? Okay, what I plan on talking to everybody about is something that I stumbled upon because of an experience I had. And, this is not an accounting course. What this is to introduce you to, if you want to run a small business, some of the starting principles of how you would do the accounting for your small business. Fortunately today, here I'm going to give you some handouts. I'm going to share those. I would normally have a ton of handouts for the whole audience, but I don't want to waste the paper trying to be green. Anyways, today things have changed in accounting a lot because of software. Essentially what's happened is that you no longer have to be an accountant to record or do the duties of an accountant. That's why I say junior level accounting for a startup business. You're not a CPA and you're going to be working with a real accountant, but what you can do today is basically take care of your business by counting the beans without hiring a person. Now, you can also, the software is expandable, and what's nice about a lot of the software is that it can lead on and grow with your business as you grow. So what I wanted to concentrate on is what basic skills you have to know to get introduced to accounting, and then that will lead on how to use the software for small business accounting. So what the first thing I'm going to do is I'm going to review some accounting terms with you. You probably have heard them. I'm not sure how well versed you are in accounting terms. Rather mundane and boring to some. However, these accounting terms really represent the core elements that if an investor would approach you and want to buy your business, he wants to see these terms in that he wants to see these accounting terms displayed in the numbers for these accounting terms. And also I'm going to show you a little bit about QuickBooks and what it can do. Okay, so basically these accounting terms are essentially language how you keep track of your money. Your inputs and your outputs, your gazindas and your gazadas. Money is the most important thing. It represents stability of your company, and a lot of people enter in small business with great ideas, but they don't understand it's all about cash. Cash is king. Now, even if you run a nonprofit, you have to worry about how you're going to spend your money, where you're going to spend it, and also, as your business grows, if you don't have your accounting system set up, you will not be able to demonstrate how well you're doing. So the first term I'm going to introduce you are two terms, is accounts receivable and payable. Everybody kind of knows about that, but I'm just going to put it down because it is a term that they use a lot in accounting and also QuickBooks. Accounts receivable is the cash or the sales you get from your customers. Usually it's in the form of a service or a product you sell. Accounts receivable is turned to an asset, which I'll go over. And what happens is that a lot of times in your business, you need to track these very well because you'll sell services to people and they won't pay you for a while. And so there's a whole strategy on how to collect that money. And you can't just simply hope they pay you. You have to really have a strategy how to collect your money. Because a lot of service consultants are like that. Unlike products which you sell in a store where the person comes in and buys and gives you money right away. Accounts payable is what you pay out to your vendors. And that's called a liability, and I'll go over that. Accounts payable is, you want to minimize your accounts payable, but also you'll have that on your books, and you may not be paying out to a vendor for a certain period of time because you may not have the money. You may be strapped for cash. So you have to have a system of tracking that. And accounts payable is a figure that they really look at very closely when they're looking at your books. The petty cash account, the reason I mention that for small business, because usually you're going to make, for small business, a lot of small purchases, and you just want to run up to the store and buy some staples or whatever. So you might give your business partner $100 in cash. Also, you may go on a trip, a business trip, and you want to give somebody $1,000 to have spending money on that trip. So that's called the petty cash account, and you track that as well. Liabilities. Liabilities, you know, that's a bad word, but it's actually in accounting, it's just a word to describe the things that are counted against how much money you have. Liabilities are accounts payable. That means, like, if you ever see someone's books, or if you ever see a major business's books, accounts payable will be listed as a liability, because if you just saw their accounts receivable, you'd think they're doing very well. But what if they had 10,000 accounts receivable, but 20,000 is accounts payable? They're underwater. So that's called a liability. Other liabilities are maybe taxes owed, anything you owe that you haven't really paid yet, or a mortgage payment. For instance, a lot of businesses, you got to look at their books closely. They'll say, we got $100,000 in assets in the bank, but their liabilities are at $70,000 to $80,000. So they're not doing very well. You know, you don't want your liabilities to that extent. Assets are things that the government terms as material wealth. You have your bank account, but also assets can't necessarily be written off when you buy them. If your business buys a building, that's an asset, and you can depreciate it over time, but that building, the government considers, when you buy it, it's not an expense, it's an asset. You own that, and that may, like, for instance, the city of Seattle determines your house is an asset and taxes you on it. And the government does the same thing with your asset. It looks as if your assets grow, and it's just a measurement of your success. Actually, you want your assets to grow, and that's how you can tell a business is doing very well. Owner's contribution is an important metric, because if you're starting a business with someone, two people are going to put in a certain amount of money. And you can determine by how much you contributed, how much of the business you really own. Lastly, your expenses is things you can write off right away. It's the items that are such, like you buy a ream of paper, you have a dinner with